So, if you're new to investing, I bet you've stared at the market and asked yourself one huge, overwhelming question. It's the question that stops so many people dead in their tracks, and it's exactly what we're going to tackle today. Let's get right into it.
Yep, that's the one. This is the question everyone asks. It can feel like you're trying to find a needle in a massive global haystack, but what if I told you there's a system, a clear framework you can use to find the answer for yourself? That's what we're going to build together right now.
We're going to walk through this simple 6-point checklist. Seriously, think of it as your personal roadmap, taking you from feeling confused to feeling confident. By the end of these 6 steps, you'll have a powerful method to analyze pretty much any company that catches your eye.
Okay, first things first. Before you even think about putting a single dollar into a company, you have to answer a really basic question. What do they actually do? This is all about understanding the business itself, and that always starts with its sector.
A sector is basically just the neighborhood a business lives in. Is it in technology, healthcare, energy? This is so crucial because you're not just buying a tiny piece of a stock, you're becoming a partner in a business. You've got to ask yourself, is this a neighborhood that's growing? Does this kind of business actually have a future?
This slide makes a fantastic comparison. Choosing a stock is a lot like deciding to open a shop. You wouldn't open a high-tech electronics store in a tiny village with no electricity, right? Of course not. You'd analyze the location and the demand first. It's the exact same logic here. Find a promising sector, like tech or renewables, and figure out if it has a bright future before you even look at a single company.
Okay, so you've picked a promising sector. Awesome. Now for our second check, we need to kind of zoom out and look at the world outside the company. What's the news? What's the chatter? What's the buzz all about?
See, a stock's price doesn't just exist in some little bubble. It gets pushed and pulled by headlines, political drama, industry news, and even social media hype. Sometimes it's based on something real, but a lot of the time it's just noise designed to influence investors just like you. And this quote from our source material, wow. It's blunt, but it is so important. It's a huge warning. Don't get swept up by some charismatic TV personality telling you what to buy. People can literally be paid to pump up a stock. Your job is to learn how to separate the real, solid analysis from all that manufactured hype.
And look, here's a perfect real-world example of how this plays out. Before a major election in India, the media built this strong story about a certain outcome, and the market soared on that expectation. But on June 4th, the actual results were different. And what happened? The market crashed and investors lost billions. So the point is, news isn't just background noise. It can have a direct and sometimes brutal impact on your money.
All right, moving on to a check that is honestly so important, especially if you're in it for the long haul. You've looked at the business, you've looked at the buzz. Now it's time to look inside the company and ask, who is actually running this show? Just think about it this way. You wouldn't send your kid to a school without checking out the principal, would you? It's the same idea with a company. The management team is steering the ship, so you got to do a little homework. Are these leaders experienced? Do they have a track record of success or a string of failures? Let me tell you, a great company with bad management is a bad investment, period.
Okay, now it's time to get into the really juicy stuff, the numbers. This is where we get to the heart of a company's performance. Step 4 asks the most fundamental question of all. Is this business actually making any money? And listen, the key word here is consistent. Anyone can have one good year, right? We are looking for a pattern. You want to look at their financial history for at least the last 3 to 5 years. Is that profit line climbing steadily, or is it jumping all over the place? That's what tells you if a company is truly strong and stable. Now this is exactly what you want to see. It's like a beautiful upward staircase of profit, year after year. This chart is telling you that a company isn't just getting by, it's thriving, it's growing its earnings. This is one of the clearest signs of a fundamentally strong business. So as the company's profit grows, your slice of that pie should be growing too. And that's exactly what earning per share, or EPS, tells us. It shows you how much profit belongs to each single share. In a healthy company, the EPS chart should look a lot like the net profit chart, climbing steadily upwards. It means their success is becoming your success.
So the company's making a profit. Fantastic. But, and this is a big but, profit is only part of the story. For our 5th check, we need to do a quick health checkup on the company's finances. And for that, we look at something called the balance sheet. But don't worry, I promise we're going to make this super simple.
You can just think of the balance sheet as the company's financial report card. We're going to focus on 2 super important parts: what the company owns, its assets,
and what it owes, its liabilities. Let's start with the good stuff, the assets.
First up, assets. This is all the physical stuff the company owns. Its buildings, its machines, all of that. I love this analogy. Think of a street vendor who starts with just a small cart. Then he saves up and buys a small shop. And eventually he owns a big store. You want to see a company's assets growing over time, just like that. It's a huge sign that the business is expanding and putting money back into its own growth.
Okay, now for the other side of the coin, liabilities. And really, we're focused on one major thing here, debt. The rule is dead simple. You want to see that debt going down over time. A business that's buried in debt can't grow. It can't innovate. A healthy company works to pay down its loans and stand on its own 2 feet. Decreasing debt is a massive green flag.
Okay, we are at our final check, and honestly, this might just be the most important one of all. We know the company is profitable on paper, but is real cash actually hitting its bank account? This is the ultimate health test for any business.
So, when you look at the financial statements, you're going to find a line called net cash flow. This number tells you the bottom line, the total cash that came in versus what went out. The most important thing you need to see is that this number is positive. It means more money is coming in than going out. Simple as that.
A positive and hopefully growing net cash flow is one of the best signs you can possibly find. It means the business is actually generating more cold, hard cash than it's spending. This is the money it can use to pay down debt or invest in new projects or give back to shareholders. You know the saying, profit is an opinion, but cash is a fact.
And there you have it, your complete 6-point checklist for fundamental analysis. Understand the business, keep an eye on the news, check the leadership, look for that consistent profit, make sure assets are going up and debt is going down, and finally, check for that positive cash flow. This is your toolkit to cut through all the noise and make smart, informed decisions.
We've laid out the roadmap for you. You now have a powerful framework to look at any company and see what's really going on beneath the surface. The power is literally in your hands. So, the only question left is, which company are you going to start with?